I'm going to show you today how to take a breakout trading system that makes profits but is too erratic and has too big of drawdowns, and use options to greatly minimize drawdowns and add a lot of consistency to the returns. So what you see on your screen are two sets of returns, one in orange, one in blue. The orange returns are the underlying futures market, and the blue returns are the same market but using options. So first I want to ask you, which of these returns would you prefer? Some traders approach trading and believe that what they really want is to make the most profits. But that is not the context of trading that leads to long-term success. Because even if you have a trading strategy that ends up with the most profits, if the drawdowns are too costly, if the consistency is not there, very rarely will somebody actually follow through with that system for the long term. And if you are funded and you're trading for a prop firm, very unlikely that you would be able to scale up something that looks like the orange set of returns rather than the blue. So even though the blue ends slightly less, over the long term, that's something that you're more likely to stick with, you're more likely to get scaled up with, and the return on drawdowns are far more attractive overall. So the underlying, when there are losses here in the futures market like this, that is from whipsaw. So what's happening is if there's a breakout to the upside, that is long, and then if we make a new 5-day low, that's a short. Very simple breakout system. Not a lot going on there, no secret sauce. Just new 5-day high, get long, new 5-day low, get short. It's profitable overall, and this is a one-year study, but many years of study on this and out of sample results are all profitable. The options trades, you can see the pattern is very similar. The drawdowns happen in a similar time, the returns happen at a similar period of time, but the magnitude of each is smaller. So although the returns are smaller in the options, the drawdown is far less. Okay, and I'm going to show you exactly how that happens. So the trade that we're working on and doing here is called a credit spread. And the credit spread looks a little bit like this. Let me just kind of shrink this in for you. So this is a credit spread. So on a long signal, you would sell a put and you buy a put. Very simple. I actually prefer near the money credit spreads. It's very common to hear about out of the money credit spreads with high probability. But when you're dealing with directional trades, it's better to get more credit, more premium in there. And where the edge comes from, where the added value comes from is two things. First of all is the maximum risk. So buying that put down here means as if the market really crashes against you, this actually begins to reduce. The risk gets reduced and it ultimately gets capped down here at expiration around 41.5. But even during the trade where it's being held, little by little, you're actually having less exposure to a massive move against you. The other part of the edge, it comes from premium decay. All of this gain from here to here can be had at expiration, which is just a few weeks after entry point. So all of this right here is premium that can be collected if you are not right, meaning the market ends up exactly where you start, or even goes against you. You can actually experience all of this positive P&L right here. And one area of this trading, why it does not have as big of returns, is because it also does taper off the returns on the upside. So if you have a huge win in your favor, you actually hit a ceiling where you can't make any more. Now, some also will look at this and say, well, this is not positive return or possible yield versus total risk. So this would be the risk and this is the return. That's only true if you're playing only probabilities, where you just put this trade on and you run it to expiration. As traders using signals or using levels to trade off of, we're defining risk at a much different point. Your capped risk is actually your stop loss is the other side of the breakout. So if you actually break down and make a new 5-day low, so let's go look at the chart and see where that would be. So this is a breakout to the upside, so we'd be looking down here at about 42 initially. so it was a little further than I first drew it. So let's put that in here. So right here, this is the defined risk where you're planning to get out of this trade. So this is the risk and this is the possible return, which is a little bit more balanced. However, that's not just a one-to-one. That just now becomes equal as far as stop loss versus the profit target being most of the premium up here on the upside. The other part where it adds all the value, two reasons. Number one, we're trading a market that tends to have follow-through, has enough follow-through on the signals that we're trading to generate alpha just from momentum. Secondly, where we're adding value is premium decay. So over time, this profile becomes more like the expiration profile. So even if no change is made, a single contract here can make a few $100s after just a few days, just a little over a week in there. So that is what goes on with that. So accumulating 29 trades, which would be a very long video for me to walk through every single one of these trades and the examples side by side, but I've already done that work and shown you what the end result is. So the underlying, very big drawdowns, but you get those few very outsized wins that pull it back up and get it to that higher end profitability, but at too big of a cost. With the options trades, you can define your risk, you make your drawdowns much smaller, and you ride that premium decay that really keeps the returns elevated, keeps them more consistent in there. So, and there are many occasions. Let's see here, I can show you the return cycles. So here we're going to look through column G and then column E, and we're going to look for trades, individual trades. It's actually the columns before it. Here's the actual returns. I'm sorry about that. Here's the actual returns. So what we're looking for is times where the options made money and the futures did not. So C, column C is the options trade. Column D is the futures trade. And these are the individual returns, what each trade made or lost. So trade number one, you have the options trade made some money when the futures trade lost. These are just single contracts just for apples to apples, as close as we can get, even though we're using two different asset types on the same market. But if you trade the outright futures, you would actually have a loss on that first signal versus a win here. The second trade, the futures credit spread on the options lost 862, but the outright futures contract took every single tick of loss on the other side and lost 2,300. This is a great one. This happens quite often. Is trade number three, which is this one right here, between 2 and 3. The options actually had just enough time go by to allow you to get out at break even on the opposite signal, where we actually went to the other side of the channel on that. All right, so for me, I would take the blue set of returns any day of the week over something that potentially can end up more profitable, but I'm going to have to go through much bigger drawdowns several times on the way to it. That's something, I don't know, 9 months into this, I'm going to be around for that final couple of trades that takes it above the more consistent returns. So we're going to actually discuss this specific trade, this system, the exact options selected in our weekly workshop. And that's every Wednesday, early afternoon, U.S. market hours. You can learn about that at smbu.com/workshop. So we go over lots of different strategies. This is one we're going to review. And it's actually an extension of a lot of the systems we've been studying, from using simple indicators and systems for when to be in a certain directional bias, and then using options trades to add edge to relatively simple signals that allow us to filter certain market conditions. So if you'd like to learn about that, I invite you to come check it out. You can do a first month trial discounted in the workshop, so I hope to see you in there.